TEG Oil is growing their footprint in Egypt's western desert, now advancing two key projects that could redefine the region's unconventional oil potential. Unconventional oil is thick crude trapped in tight rock that requires advanced extraction techniques. Nowadays, TEG is positioning itself to move from proof of concept to full-scale development. Chairman Abby Badwi joins us back here in the studio again. Abby, good to see you.
Good to see you too, and thank you for having me.
Well, listen, we have talked about this before, but there is multi-billion barrel potential in the Abu Rosh F formation in Egypt. What sorts of recovery rates could turn this from a resource story into a true production powerhouse?
Very good. Well, we can rely on similar areas that have produced a lot of oil from unconventional reservoir. In particular, we're talking about the Eagle Ford in Texas. Recovery factor in that region has been anywhere between 4 to 10%, depending on the location of the drilling that takes place. So if we even assume a 5% recovery factor, considering the amount of oil in place that we have the potential for multi-billion barrels of recoverable oil. Of course, final numbers will have to be refined and assessed subject to drilling results that we're going to have over the next 1 or 2 years.
Well, Abby, you've been leveraging know-how from Canada in Egypt's tight carbonates. What have you learned so far about how those techniques translate in the Western Desert?
It's very good because, we came up with the techniques and this has been widely used in Canada, of course, with places like the Montney, and we relied on a lot on Canadian experts in designing our wells and unconventional drilling techniques. But we've learned a lot from drilling our first well at the Bed 1 concession. Things like type of drilling fluid to be used in this formation, managing loss circulation when you encounter fractures, high formation pressures. All these things are very important, and we've learned a lot from that, and that will help us now to be able to design our drilling properly and our hydraulic fracture as well to be designed adequately to meet these challenges.
Well, at this point, you've got two major projects, the Bed 1 concession and the Southeast Ras Qatara concession. How do you prioritize capital and timing between these two opportunities?
So first, capital has to go to something that we have proved already. So our initial focus in this coming year is to drill additional wells at the Bed 1 concession. This is where we have proved the concept already of producing good quality oil out of the ARF formation. But what we'll learn from this, of course, is we can take the results of what we're doing in here and take it to the third concession as sort of the follow-up steps in start to test at the RF. So part of our focus is going to be testing on the third concession. So developing additional oil and production on Bed 1 and testing on the new third concession. That's the focus for 2026. Subject to results, of course, of these programs, we will expand our activities on both concessions in 2027 and beyond.
And the new petroleum services agreement that's been announced offers a substantial share of revenue for the project, but you're funding 100% of the work. Do the economics work at today's oil prices?
Actually, they do very well, and this is why, from past experience working in Egypt and working with the petroleum service agreement, at current oil prices and the share of revenue that we're getting, considering, of course, drilling costs and operating cost estimates, the project yields very positive economics. Of course, you have to drill the wells on time and on budget, and that's where, as you continue drilling, we'll be able to refine our drilling and operating costs, and of course, economies of scale will further enhance our values.
You have petroleum services agreements in place. What are the biggest levers you have to move to improve your margins across your projects?
Well, basically the main things, as I mentioned, is to refine your drilling and operating costs. That's very, very important. These wells are not inexpensive to drill. A 1,000 to 1,500 meter horizontal will cost anywhere between 10 and 12, $13 million. That's US dollars. So trying to bring those numbers down into the 8 or 9 million is going to be an important step to make the project more economic. And this will happen, of course, when you drill multiple wells. So you engage a rig to drill several wells back to back, only one mobilization, demobilization of the rig, tying everything into one production facility. All of these things will enhance, of course, our drilling and economics margin.
Well, on that note, I understand that right now you're looking at evaluating multiple wells and there's new drilling ahead. What would you say is going to be that clear signal that this company is shifting from testing, kind of proofing out your proof of concept to full-scale development?
So, of course, it's well results, right? So that's what we are going to be looking forward to. Our first well is anticipated to start drilling sometime in late first quarter or in April of 2026. The well will take about 2 months to drill and complete and put it on production. So production results and performance of the well is going to be the big signal that well productivities will make us decide on moving into a full development. So we have another well is to be drilled later this year. We hope to drill more wells as well. So over the next, we have an evaluation period of 2 years. So over this 2-year period, we're going to collect a lot of information. We're going to have revenue. We're going to have cash flow, and that will give us a clear signal to pull the trigger and go ahead with a full development plan.
That's Abi Badwi, chairman of TAG Oil. You can go to CEO.CA/TAO to go to the company's message or board or channel. Thanks for watching.